Over $1 trillion vanished from the chip market in a single afternoon. Not 2008, not the dot-com crash last week. If you own a single tech stock, you need to know exactly what triggered this and whether the worst is already over. This is Bellwether. Let's get started.
Over $1 trillion. Gone. In a single afternoon. That is not a typo, and it is not a headline from the 2000 dot-com collapse. That happened last week, in the chip sector alone, and if you own any tech stocks at all, you need to understand exactly what triggered it and whether the worst is already over or just getting started. The semiconductor sector has been the beating heart of the AI investment story for the past 2 years. NVIDIA alone went from roughly $300 billion in market cap to over $3 trillion on the back of one narrative: every major corporation on Earth needs to buy AI chips, and there is no shortage of buyers. That story made a lot of people a lot of money. But stories have a way of meeting reality eventually, and on June 5, 2026, reality showed up with a sledgehammer. I have been covering this beat for 15 years. I have watched the iPhone supercycle, the cloud build-out, the cryptomania, and the post-pandemic tech implosion. And I will be honest with you, when I first read the headline about a single afternoon trillion-dollar wipeout, I called BS. I thought it was a rounding error or some dramatic framing from a financial wire desperate for clicks. It was not. The numbers are real, the damage is real, and the cause is more complicated than almost anyone in the financial press has bothered to explain properly. Here is how I am breaking this down. First, the actual catalyst, because it was not what most people think. Then the damage report, company by company, with real numbers. After that, the twist that most retail investors completely missed because it was buried in the macro data. And finally, at the end of this video, I am going to tell you the specific signal you should be watching right now to know whether this is a buying opportunity or the beginning of something much uglier. So let us start at the beginning. The chip crash of June 5th did not start with NVIDIA. It did not start with some government announcement or a Federal Reserve press conference. It started with Broadcom. Now, if you are a casual tech investor, you might not follow Broadcom as closely as you follow NVIDIA or AMD, and that is understandable. But Broadcom is one of the most important companies in the semiconductor supply chain, generating roughly $51 billion in annual revenue and serving as a critical supplier to hyperscalers like Google, Meta, and Apple for custom AI chip designs. When Broadcom reports earnings, the entire chip sector listens. What happened on June 5th is that Broadcom issued a financial report that was, by most objective measures, strong. Revenue was up. AI-related revenue was up significantly. But Wall Street had priced in perfection, and Broadcom did not deliver perfection. The company's guidance for the next quarter came in slightly below the most aggressive analyst estimates on the street. That gap, which in dollar terms was not catastrophic, was enough to shatter the confidence that had been propping up the entire sector. The market's message was brutal and immediate: if Broadcom, the pick-and-shovel play on custom AI silicon, cannot blow past expectations, maybe the AI infrastructure spending boom is starting to plateau. Actually, scratch that framing, because it undersells the psychology at work. This was not rational analysis. This was a sector trading at multiples that assume exponential growth forever, suddenly confronted with any data point that suggests growth might be merely very good rather than historic. At those valuations, merely very good is a crisis. The damage report is where this gets genuinely staggering. Micron technology dropped 11% in a single session, erasing $127 billion in market value on its own. Think about what $127 billion means in physical terms. That is roughly the entire annual GDP of Hungary, gone from one company's market cap in one afternoon. AMD fell 5%. NVIDIA, which had already been under pressure earlier in the week, took another significant hit in afternoon trading. The PHLX Semiconductor Index, which tracks the broad chip sector and is commonly called the SOX Index, posted its worst single-day percentage decline since early 2025. The total market cap destruction across U.S.-traded chipmakers topped $1 trillion by the closing bell. I want to put that number in tactile terms because $1 trillion is too abstract to feel real. If you stacked $1 bills flat, 1 trillion of them would reach from the Earth to the Moon and back roughly twice. That is the amount of paper wealth that evaporated from the semiconductor sector while most people were eating lunch. Now here is what the financial press mostly glossed over. The Broadcom earnings miss was the match, but the room was already full of gas. The morning of June 5th, before markets even opened, the U.S. Bureau of Labor Statistics released a jobs report that came in significantly hotter than economists expected. Strong employment data sounds like good news, and for most of the economy it is. But for high-growth tech stocks, it is a problem. A strong labor market means inflation pressures stay elevated, which means the Federal Reserve has less reason to cut interest rates. Higher rates for longer means the discount rate applied to future earnings goes up, which mathematically compresses the valuations of companies whose value is mostly theoretical profits a decade from now. NVIDIA trading at 35 times forward earnings is defensible in a low-rate world. It is much harder to defend when the 10-year Treasury yield is climbing and the Fed is signaling patience. So you had two things hitting simultaneously, a sector-specific shock from Broadcom's guidance and a macro-level rate shock from the jobs data. Either one alone might have produced a bad day. Together, they produced a historic one. And here is the part that should genuinely concern you. The AI bubble debate is not new. Skeptics have been calling the top on NVIDIA since the stock was at $400. They have been wrong, repeatedly, and embarrassingly. But the Broadcom report introduced something different, a credible data point from inside the supply chain suggesting that hyperscaler AI chip orders might not be accelerating as fast as the most bullish models assumed. That is not a pundit saying AI is overhyped. That is a supplier to Google and Apple saying the order book is not growing as fast as Wall Street thought. In part 2, I am going to show you the specific financial metric buried in Broadcom's report that most analysts are ignoring, and why it tells you more about the next 6 months of chip sector performance than any price target on Wall Street. There is a line item in Broadcom's June 5th earnings report that almost nobody in the financial media bothered to read carefully, and it is the most important number in the entire story. Broadcom's AI revenue for the quarter came in at approximately $4.1 billion, which sounds strong. But the sequential growth rate, meaning the increase from the prior quarter, slowed to roughly 4%. Compare that to the 40+% sequential growth rates the company was posting throughout 2024 and early 2025. The absolute number is still big. The growth trajectory is decelerating sharply. And in a sector priced for acceleration, deceleration is the only thing that matters. This is the part where I need you to think like an analyst for a moment, because this distinction between absolute performance and rate of change is what separates investors who made money in this cycle from the ones who are going to get hurt. NVIDIA's data center revenue is still enormous. AMD's MI300X chip is still selling. Micron's high-bandwidth memory is still in demand. None of these businesses are collapsing. But the question the market is now asking is whether the growth rate has already peaked, and if so, are these stocks priced for a world that no longer exists? So what do you actually do with this information? Here is the practical framework I would use right now if I were actively managing a position in semiconductor stocks. Step 1. Separate the companies by their exposure to the deceleration risk. Broadcom and Marvell Technology derive a large portion of their AI revenue from custom silicon programs with Google and Amazon. Those programs are on multi-year contracts and are not going away. The deceleration risk there is real but manageable. NVIDIA, on the other hand, is still selling general-purpose GPU clusters to every company that wants to build or expand an AI training infrastructure. The demand there is genuinely harder to predict because it depends on how many new AI projects get greenlit every quarter. AMD sits somewhere in between, with its Instinct GPU line competing directly with NVIDIA at the high end but with a much smaller installed base. Step 2. Watch the hyperscaler capital expenditure announcements. Microsoft, Google, Amazon, and Meta are the 4 companies that between them account for the majority of AI chip purchases in any given quarter. Microsoft has already publicly committed to spending over $80 billion on AI infrastructure in fiscal year 2026. Google's parent Alphabet said in its last earnings call that it would spend approximately $75 billion on capex this year, with AI infrastructure as the primary driver. These are not vague promises. They are guidance items that executives are legally accountable for. If any of those companies revises their capex guidance downward in the next earnings cycle, that is your signal that the Broadcom deceleration was a leading indicator of something systemic. If the capex guidance holds or increases, the June 5th crash was a panic-driven overreaction. Step 3. Track the Taiwan Semiconductor Manufacturing Company monthly revenue reports. TSMC releases revenue data every month, and because they manufacture chips for NVIDIA, AMD, Apple, and Broadcom simultaneously, their numbers give you an unfiltered view of actual wafer demand that is much harder to spin than individual company guidance. If TSMC's July and August revenue reports show continued strength in advanced node bookings, specifically 3nm and 2nm capacity, the AI build-out is intact. If those numbers soften, you have confirmation that the slowdown is real. Now for the advanced insight that most retail investors and even a lot of professionals are missing entirely. The Federal Reserve angle in this story is more dangerous than it looks on the surface. The June 5th jobs report showed the U.S. economy added more jobs than expected, which pushed the probability of a Fed rate cut in September 2026 down to below 30% according to CME Group's FedWatch tool. That matters for chip stocks specifically because of how semiconductor companies fund their research and development cycles. Companies like Intel, which is in the middle of a $100 billion fabrication expansion program in the United States, are carrying significant debt loads. Higher rates for longer means the cost of servicing that debt goes up, which squeezes the cash available for R&D and capital investment. Intel's situation is already fragile enough without an extended high-rate environment piling on. But there is a second-order effect that is even more insidious. Many of the smaller AI semiconductor companies, the ones building inference chips or specialized accelerators, are still pre-revenue or barely profitable. They have been surviving on venture capital and secondary equity offerings. A rising rate environment makes those equity offerings more expensive and makes institutional investors less willing to fund speculative hardware bets. That is how you get a shakeout in the AI chip space. Not a collapse of NVIDIA or AMD, but a culling of the 50 or 60 smaller players that raised money during the peak of the hype cycle and never shipped a product that could compete at scale. Now, back to the open loop from the start of this video. I promised you the specific signal to watch to know whether June 5th was a buying opportunity or the beginning of something worse. Here it is, the date is July 22, 2026. That is when Alphabet reports its Q2 earnings, and the single number that will define the next 3 months of semiconductor trading is Alphabet's Google Cloud capital expenditure figure. If Google Cloud capex comes in at or above the quarterly run rate implied by Alphabet's full-year $75 billion guidance, the June 5th crash was noise. If it comes in even 5% below that implied run rate, you will have confirmation that the biggest AI spender on Earth is pulling back, and the Broadcom deceleration was the canary. Mark that date. If this breakdown gave you a clearer picture of what actually happened on June 5th than anything you read in the financial press, do me one favor, subscribe to Bellwether and drop a comment telling me which chipmaker you are watching most closely right now. I read every comment and I will respond to the ones with the most specific takes. The analysis on this channel only gets sharper when the people watching it are engaged. The chip crash story is not over. The next chapter is the hyperscaler earnings cycle, and the numbers coming from Microsoft and Google in late July are going to either validate or destroy the bull case entirely. There is a full breakdown of how to read hyperscaler earnings for chip sector signals already queued up on this channel. Watch that next.
So here's your signal, July 22nd, Alphabet's earnings. If Google Cloud capex holds, June 5th was just panic. If it drops even 5%, the pullback is real. Subscribe to Bellwether so you don't miss the verdict, and tell me which chip maker you're watching.